sense, it is more relating to the use of fixed costs. As a part of a company's cost structure, if they are using fixed costs, we associate the usage of fixed cost to a word called leverage. And typically what we see is companies use fixed costs, one from an operating dimension. For operations purpose, if the fixed costs are being used, that is called as operating leverage. And if for the financing purpose, fixed costs are used, then we call as financial leverage. So these are the two broad forms of leverage which we see with respect to the organizations. And why is it important for us to understand this leverage? This leverage is the major driver for the company's earnings. The profits of the company, leverage is a key driver of it, and it is more to do with the volatility of those companies' profits. It can take those profits very much up or down. It is more responsible for swing or volatility in the company's profits. So that's the reason understanding of the leverage is very much important. It is very much possible that during positive times, when the market is doing good, when the company is doing good, the profit would be exorbitantly higher, and at the same time, when the situations are bad, the companies can go exorbitantly into bigger losses as such. So understanding of a leverage is very much required, because one, it's a key driver to assessing the risk of the company. Just by looking at the leverage, someone can talk about what is the kind of risk that is built into the company. The higher the leverage, probably I can say the higher is the risk that is associated. Taking a risk can give better returns when things are going well. They may bounce and backfire when things are not going well. At the same time, leverage brings a lot about the quality of the management decisions. How sensible is the management? How much risk oriented is the management? To what extent they are risk averse? What are the kind of steps they are taking to reduce or mitigate the risk? All these things can quite comfortably be understood just by looking at the leverage structure of the company. And at the same time, this leverage will really help in terms of forecasting the future cash flows, and probably even coming up with an appropriate discount rate, because discount rate is more based on the risk associated with the firm. So it plays the leverage, the usage of leverage and the understanding of the leverage of the firm plays an important role in its valuation as such. So probably these could be the major dimensions or major necessities for understanding the leverage, right? So with that as a base, let's just try to get a broad high level overview of the word called leverage and how is this leverage looked at in the organizations. So as I said, leverage plays a very important role with respect to the volatility of the earnings or the profits of the organization. Right, the higher is the leverage, probably I can say higher is the volatility. And even the cash flows uncertainties can come up quite higher as the leverage is much higher in the organization's cost structure. And even it becomes more and more of a risk for the lenders of the company, and at the same time it's even a risk for the equity investors of the company as such, because the earnings are volatile. So every party who is investing in such kind of business feels the pressure feels the risk that it may not get its money back. So because of that, the valuation of the firm gets badly affected. So which means the discount rate that is used to value the future cash flows of the firm, they get much higher because of the higher risk built into them. And so when the markets are really down, those are the firms which face the biggest consequences of or biggest chances for filing for bankruptcy and going into financial distress. When the economy is doing good, there is a positive side as well. When the economy is doing good, these are the companies which generate extraordinarily high profit compared to many of its competitors. These companies generate extraordinarily high profits when market is doing well, but in the downturn they are the ones who are going to exit the first. So that is where we are looking at the cost structure, okay, to see to what extent the fixed costs are there. We will actually look at the cost structure of the company. Generally, we divide the cost structure into variable costs and we categorize it into fixed costs. Whenever I am talking of variable costs, they change with the production and sales. So they are more related to the production, they are more related to the units getting sold. So they can be classified in terms of, they can be associated with respect to the number of units produced or sold. For example, cost of goods sold, it can be linked directly with the number of units that are getting sold. Raw materials that are purchased, it can be linked with the number of units that are getting sold. Hourly salaries, hourly wages, they can be linked with the amount of production that is being done. So they all go as a part of variable expenses for a company. Whereas when I am looking at fixed costs, they are not dependent on the production, whether you produce something or not, whether you sell something or not, they are incurred. So they are not linked directly to the sales or something, which means rent for a building. Whether I produce something, rent for my factory, whether I produce something or not, I have to pay rent for it. If I have taken a loan, the interest on it, whether I produce something or not, I have to pay an interest on the loan. If at all my employees are salaried rather than hourly wages, whether something is produced or not, I have to pay for their salary. So all these things get considered as a part of fixed costs. So every company definitely will have some amount of fixed costs, some amount of variable costs. So different kinds of companies may have different proportions of the fixed as well as the variable. Right? Probably some companies may have a good proportion of fixed costs compared to the variable costs. So these kind of costs, especially interest on loan and all, which are fixed, we say they are fixed financial costs because they are fixed with respect to the capital that is being raised or the funding that has been raised for executing the operations. Whereas the fixed costs in these lines are called as operating fixed costs because they are more and more relating to the operations of the firm. So depending on the mix, whatever the company is going between the variable and the fixed, they will be exposed to different levels of leverage and they will be associated with different kinds of volatilities as a part of their earnings are concerned. Right? So examining the cost structure of the firm is more and more important from that particular dimension. Now, once we know the cost structure, we have to see to what extent, what are the different kinds of risks that come out of this cost structure. Overall, I am going to look at the two major forms of risk. One is the business risk, two being the financial risk. any company which is executing its business, you see that it can arise either from the business core business related activities, or two, from the financial related activities. So initially I am focusing more on the business risk, whatever is the risk that is associated with the operations of the firm, and the kind of volatilities that is associated with operations related profit. So I will not look at the overall profit of the organization, I will look at only the operating earnings or operating profits. Now, the business risk could stem from two different dimensions. One, because of sales, two, because of operations. When I am saying sales, the company is not able to sell as expected. So revenues are getting affected because the company is not able to sell the goods and services as projected. Probably there are so many things that could determine that. The economy could be bad. So because of that, they may not be able to sell to the expectations. The competition in the industry is so dynamic, they were not able to meet their targets. The regulations of the government became a restriction for them to meet their target. Probably the demographics, the customer taste changing, all these things really play an important role in the companies being not able to meet their target. So either they may not be able to meet the target with respect to the price, or they may have issues with respect to the quantity of goods that they wanted to sell. So because of all these things, the sales risk is bound to occur, which is a part of the business risk, right? And the second dimension, which is the operations related, is more to do with the costs and using the fixed costs as a part of the operations. The risk that is getting affected, the operations profit, we know how do we compute the operations profit? The sales minus the costs of goods sold is what, and minus any other operations expenses that are there. This is what is giving rise to operations profit. So which means if the operations profit is getting disturbed, it could be disturbed either because of the sales or because of the expenses, either the production expenses or any other operating expenses. So because of them, the operating profit is going to come up, and that is what we are seeing here. With respect to operations, if I am looking at the operations related costs where I am using fixed costs, the higher and higher I am using the fixed costs, the higher is my operations risk. So the business risk can actually stem either from the sales risk or from the operations risk. But to a large extent, when I take one single industry, my assumption always is the sales risk is the same for almost all the players in the industry, because probably if I talk about a two-wheeler manufacturing industry, the economy plays the same role for all the companies in the industry. Competition is similar for all the companies. Regulations are similar for all the companies. So the sales related risk and to some extent the operations related risk might be similar for the companies which are operating in the similar industry. Only small differences could very well occur between them. So overall, even the cost structure, if I see, it may not be varying that drastically. There could be small changes between variable and fixed proportion, but if at all they are having the same cost structure, then whatever is the sales risk that is more and more, whichever company is exposed to more and more sales risk, its business prospects get impacted very badly. But when we look at the operations related risk, the operating